Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully you guys all had a great Thanksgiving Day holiday. On a sobering note, only 74% of our fellow Americans actually celebrated Thanksgiving this weekend. So definitely give thanks if you're able to do so, as a lot of folks are hurting out there. So I'm going to start with some of that Dow economic data, work our way into the markets and then the strategies of where we see things going from here. So on an economic front, 20% of Americans can't pay their utility bills right now. 37% of business owners and realtors out there have not been able to afford their office rent. Credit card debt, the highest it's been since 2008, as well as vehicle pricing. As many of you folks probably see that out there. So this is really a dichotomy of opposites from post-pandemic, when we saw, again, savings at high rates and credit card balances low. It's the inverse here. So again, in the retail sector has been doing okay here over the last month. In fact, the sector has surged above what we call the 50-day moving average. Still under the 200-day moving average, but it's been a mixed bag across different stores. But again, it just shows that people are spending on their credit cards as their savings are down. So we'll watch that. Now, when you look at inventories, we've seen mixed bags with the Walmarts and Targets, but now these dollar stores, apparently a manager had said that their inventories are piling up to the roof, and he's not the only store. These are across the country. So very, very, very interesting, certainly to watch that. Now, beyond some of that, if you look at, just your mortgage rates and what's happening to the housing market, rates 2 years ago about 2.7, now they're about 6.58. With home prices obviously above that. But what does that do for future demand? We shall see. It's been down recently, as you probably guessed. Commercial real estate, the same as many of these large tech companies, as we mentioned, and companies out there are shedding their leases, certainly driving commercial real estate down as well. Now, what we've seen, again, on commodities, energy's been up most of the year, but certainly has been pulling back, certainly pre-recessionary thoughts there, but also more of the crazy COVID policies there in China, which starting this week as well, another soap opera, so which we won't go into great detail on that, although we will pinpoint that and come back to China on a more ominous note here in a moment. Now, as far as the market goes, we've had a nice run from October, November. So in your strategies like global macro, velocity, your sector momentums, been taking advantage of pockets in certain sectors as well as individual stocks where they make sense. And then, of course, your bull bear strategy, your macro momentum, as it's now called, has been kind of that bedrock of conservative holdings with that SNOX, the Federal Reserve Overnight Repurchasing Agreement Fund there, earning 3% and change currently, holding that down as well. Again, we see the market in an uptrend in the intermediate with an overall downtrend. So many headwinds out there. The market has not proven anything really getting beyond its declining trend line, but that doesn't mean there's not pockets of opportunities and certainly to take advantage of some of these more nimble strategies. Discuss, of course, with your personal wealth advisor as far as the percentages you have allocated and how that pertains to your current risk tolerances and appetites out there. Now, again, as we look at markets, value is outperforming growth. Staples and utilities outperforming the S&P 500 on a whole. That usually, you guessed it, portends to more of a defensive nature, from that standpoint as we watch that pretty closely. Now, as we know, as we look across, the globe here on a macro level, obviously the commodity prices have been really crushing as well as the rising dollar until recently. The European economies, they have very little control, especially in the commodity, space. From that standpoint. Now, on a more ominous note, I won't go into great detail, but we keep our head on a swivel, 360 relentlessly, looking at everything that's not reported on the big three business stations here. But if you start to look right now, at gold purchases, again, back to China, and these BRIC countries have made no mistake about it. The BRICS, of course, you guys are familiar with the Brazils, Russias, Indias, Chinas of the world out there, have been investing heavily in gold, while Europe has been a big seller of gold. And again, they're looking at, gold-backed currencies to reduce the influence of the petrodollar. That's the, obviously, oil control by the U.S. dollar on pricing. So very interesting to watch. I know some have scoffed at this in the past, but this is pretty serious. And certainly with what's going on a macro and with the war and such, this cannot be shaken off. I mean, huge purchases by China in gold, and Europe's been a net seller. That's an issue. Now, as far as Europe and our friends over at Davos, again, you can look at the headlines, Google this, do your own homework. I just want to keep you informed. You won't watch this on the news. You're not reading it in a Wall Street Journal. I can guarantee you that because I read it every day along with the Financial Times. Never going to mention this. But you really have to look, you can Google this, on these central banking digital currency, the push from your friends over there at Davos, the elites, and what that would do to the retail banking and control of your financial privacy in this country. And not to overdo it, this is what they're looking to do. And it's happening. You're just not seeing it. That doesn't mean it's not happening, right? Just because a hurricane's out in the ocean, you don't feel the winds yet. In the state of Florida, you have to brace for that. And Godspeed to all your folks and clients and folks that you know and family that were affected by the past two tropical storm and then respectively Hurricane Ian before that. So what we're looking at is that's a large macro level. I'll let you Google and do your own homework. I just want to keep you aware. Again, we are cognizant of all these things that are out there and how they affect your money. Now, as far as strategy-wise, as we wrap this up on a post-Turkey weekend there, again, we remain still pretty bullish in the interim with a quick foot by the brake pedal, realizing this December could replicate the 2018 December, right? That was a huge drop. Hasn't started out that way. But some of the risk-off metrics that we're looking at is volatility, known as the VIX. Right? Some of you folks have a little participation in there. The VIX has been going down. But again, it's in that 20 price level. That can't stay for long with all the headwinds that you're looking at, including an inverting yield curve, which we'll finish up with. So again, we look for perhaps the VIX to rise as the year ends into next year as buyers in the short-term Santa Claus moment, if that still occurs, will be net sellers in January as the bear market continues with some of the ominous economic data I've given you. No surprise there, right? But there are opportunities to the upside. Now, on the inversion of the yield curve, we'll finish up there. You've heard this many times, but we don't want to assume you guys have lives out there. So the inversion of the yield curve is when the short part of the yield curve rates are higher than the long term, which is generally a dour economic view of the future. So therefore, it has actually, it precedes recessions, which we called a few months ago, but now it's becoming more pronounced. So we've been taking advantages of this in some of the strategies, easy for him to say, especially on your active capital preservation strategy. And what that has been able to do, though, on the conservative strategy there is we've taken advantage of the intermediate rates and long-term rates being lower with some holdings there as we've reduced dollar and short treasury exposure, which has worked out pretty well if you look at your statements there. So again, the inversion of the yield curve, though, is not a positive. In fact, many folks expect that rates going down are good for the market, which we've seen. But once really recessionary winds start to kick in, and you look at, like I said, the aforementioned Bank of America projections on 175,000 jobs a month being lost as we go into 2023, that could be another weight on the market as the baton is passed from the inflationary villain, right, like a Batman movie, to the recessionary culprit there, from the Joker to the Riddler, whatever metaphor you want to use. That's probably enough for me today. It's not always the sun shining. We just give it to you like we see it out there, and hopefully this is informed. My goal is so you don't have to really read any financial publication you don't want to. You should always stay educated, but we try to give it to you all here. We never forget, again, it's your money, and we just have the privilege of watching it for you. So with that being said, we appreciate your time, patience, most importantly, your trust. Stay vigilant, and Godspeed. Until next time.